Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this program on whatever platform you happen to be using. Well, it's going to be a busy week this week with the Fed meeting. Also, we have the tariff deadline, the unemployment report, and more earnings reports. We'll talk about that. And the panel also gives its opinion on the possibility of allowing you to use your 401k and invest in alternative assets. And we'll also have a discussion about the latest meme stock craze. It is coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Kerry Coghill of Coghill Investment Strategies, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fregasso Advisors. Thanks again for joining us for The Bull, the Bear, and You. You know, at the beginning of June, I asked about a potential slowdown in the markets because of the summer months, or the adage of sell in May and go away. All of you basically shook your heads no and said, no, you dismissed that adage. Well, here we are, 2 months into the summer, and I hate to say it, but you were all correct. If you had sold in May and if you owned the right stocks, you would have missed out on the continued march higher in the markets. This past week, as you know, all three major indices set new all-time highs, and one of the indices that follows small cap stocks has also been heading upward since that April low, but it is still 8% below its all-time high. And over the last couple of weeks, the last 3 weeks, as a matter of fact, the headline in the job front has been U.S. jobs claims fell last week. So it appears the labor market is consistent. And this week we get the latest inflation numbers. It just so happens also the Fed meets this week. Oh, and there's this thing called the tariff deadline, which hits on Friday. So I have an open-ended question, which most of mine are, by the way. What can we expect to see happen in the markets this week? Let's see. Frank, you started off.
Well, there are a lot of big corporate earnings coming out this week, which Kim's probably very excited about. Corporate earnings so far have beaten expectations, 80% of the companies I read. And that being said, we'll see how these big boys did. And if they've done well and they guide well, probably more importantly, the market will probably continue to grind higher.
Anybody else have a thoughts on that?
I'm going to take a victory lap that you
Okay.
said we were right. You just have to take that. Woo, woo. Okay. So I celebrated for all
Wait,
of us.
I'm sorry to interrupt, but summer's not over yet.
Ah.
Too early for a victory lap, right?
Never, never. Whenever somebody says you were right, you just grab onto that. That's what I do. Anyhow, maybe I have a low self-esteem or something that I'm trying to buoy up. Anyhow, no, I think things can turn turbulent extremely fast. We've seen that as recently as April, and April really is in the rearview mirror, so it seems. But we've got this big hurdle this week that has started off. We're taping on Monday, July 28th. Thank you. Yeah, doing the calendar math. Ooh. Anyhow, the 28th, and we're beginning one of the last pushes here for that trade deadline with China. Now, it's pretty apparent that kicking the can down the road is permissible in the Trump administration, and if we don't get an agreement between the U.S. and China, I can see extending that, the term past August 1st. That being said, there are still a lot of issues out there in the world, but it looks like the market's looking past them because of earnings. Love earnings, and most earnings are coming in stronger than expected. So I would continue to keep your eye on that to see what the markets are going to do in the next couple of weeks, if that is your time period.
Yeah. I think that it's going to be interesting. Generally in August, we tend to have lower volume on the market because people go on vacation. So we can get more volatility because of that. But where we have our eyes right now is really on that September, October timeframe, because those are the most volatile, historically have been the most volatile months of the market, really trying to reassess coming back after summer. So I think that that will be telling, and probably even a little more cautious going into this time frame, because we have seen the market expand as much as it has. I don't think that it's not justified, but as we talk about, especially looking at earnings this quarter, it's really about future earnings. And there definitely are things that we're watching. Stacy, during the opening, you mentioned the employment situation. And yes, we have seen some decent numbers there. But the one number that we're really watching has to do with job creation. That when you look at how many new jobs are coming, we really need about 150,000 a month to absorb new people coming into the marketplace. And we've hit that average over the last 12 months, but over the last 6 months, we've been at 130,000. So we definitely are keeping a very close eye on what's going on with employment. We get the report out Friday, I believe. So just some things to watch going into what is considered to be a more volatile time of year.
Boy, I don't have a lot to add to that. I mean, Carrie should probably have ended that segment, but I'll add maybe a couple points there. In terms of the news flow this week, Stacy, I really don't see a lot that's going to move the needle significantly in the markets. I mean, something's going to get done with China, whether either, I don't know, Carrie or Kim said it, whether it's this week or it gets kicked down, the can gets kicked down the road a little bit, it'll get done. It got done with the EU over the weekend. We saw something eventually will get done with China. The Fed's not going to do much this week. I think that's already baked into the pie. As Carrie pointed out, September and October are a little more volatile. Not surprisingly, September, October is when a Fed decision is likely going to happen in terms of potential rate cut. And then we talked a little bit about valuations. Look, I'm at the point now where I think you mentioned we hit all-time highs. It's a lot is baked into the pie here, I think. I think the markets can continue to grind higher, and it will be a grind, I think, at this point, even though company earnings are going to be pretty good. You're still at a point now where valuations are high. You have to really rely on these companies to grow into that valuation. If they don't, you can get another blip like we saw in April, I think. So that's sort of where I'm looking at. I mean, again, it's not really binary in terms of up 10, down 10. I think you can still grind higher, but there is that significant, or that potential for a decent pullback at some point.
All right. I do have this question. Are any of you surprised that we have not seen really an uptick in inflation based on the companies anticipating that the tariffs are going to, raise prices?
Tariff inflation takes a few months to actually work its way through the data. And we saw this after Liberation Day. Companies really front-loaded their inventory management, supply, whatever, by buying a lot and then stocking the shelves. Then over the next month or two, you see that inventory start to decline because they'd overpurchased. And now, really, with the inflation data, I think of this month and next month, that will be pretty telling in terms of whether the tariff-induced, inflation is there or is not there. But overall, I think at this point, I'm a little bit surprised not to see it having at least picked up a little bit.
Didn't it tick up a tenth or something, in fact, the last time they announced? I think it went from 2.6 to 2.7 or 2.7 to 2.8. I don't remember the exact numbers, but do I remember that correctly?
It brought, the one thing about that you did see a broadening out of some inflationary data. Like sporting goods went up quite a bit. Household cleaning items went up a bit. Those are generally sort of quote unquote telltale signs that inflation from tariff induced inflation is starting to broaden out a bit more. But I think it's still a wait and see approach to seeing how this will actually impact overall inflation, I believe. I mean, it's not going to, I don't think it's going to bring inflation down. I think the bias is to the upside. It's just to the, what degree is that going to be?
And I don't think it's going to be spiraling inflation. And I say this from a place of looking at 2017, 2018, and 2019. We had the shock of, I believe it was 25% tariffs across the board on everything from China. We were huge we still are huge buyers of things from China, but that was a real shock. And if you look back, inflation was, pretty tame after that increase in price happened. And I think, people should totally keep their eye out on inflation after, what we've lived through in the recent past. But I'm not sure that tariffs are going to create an upward spiral.
Okay. One of the reasons I mentioned the indices just a few moments ago, especially the Russell 2000, is Kim's latest newsletter from Boca Capital Partners. Kim, you said you were more optimistic about investing in smaller companies. So I'd have to ask you why, and I ask the rest of you then to give us your opinions. Kim?
Sure. Well, I've always kind of had what my first director of research called, that's Larry Horan, a shout out to Larry, the barbell method and of stock picking. And what he wanted us to do, he was the director of research at Parker Hunter. It was the sell side, so I was just writing, not actually managing money, but writing buy, sell, or hold opinions on computer stocks. And he wanted to have every analyst to have exposure to large cap and then more small or medium cap stocks. And that was really to help out the brokers in their marketing approach. But having done this, I saw that if you selected high quality, smaller companies, one of two things was going to happen. They were going to either grow into much larger companies or get bought out by much larger companies. One example, and you can't buy this stock anymore because it just got bought out, was ANSYS. ANSYS was a local engineering kind of software company, and it was very small when I started coverage in 1999 on it, and it grew into a very nicely sized medium company, probably about 20 billion market cap, and it was bought for 35 billion by Synopsys. Synopsys is another software company that helps make software that allows chip designers to really design chips today, and they are now folded into that. So that's a story of what might happen. But you have to look for high quality companies. You just can't kind of buy small companies, cross your fingers and say good luck with that.
One of the things I've always liked about small companies is, especially in a slow growth environment I think we all expect, these companies, because they are limited on what they do, if they're well managed, quality companies, as Kim points out, they are flexible. They can make adjustments to the marketplace rather quickly. Whereas large companies, that's like steering the Queen Mary. I mean, it takes two time zones to turn a Queen Mary around. These guys can turn around like a little powerboat. And I've always felt that was an advantage as long as it had good management.
That's the problem, though, Frank. As long as it has good management. When you look at the Russell 2000, by last check, and Kim might be able to confirm this, about a third of the companies have negative earnings. Still, even though we're zero rates for a long time, we've been in a strong economic environment. A third of the companies in the Russell 2000 still have negative earnings, which isn't good. Last time I checked, I think if you're looking at the very, very high level surface view, if you think you're in an economic slowdown and the economy's going to begin to slow down, most of the time you want to be biased up in market cap, meaning you want to own larger companies because the quality of earnings are generally a little bit better there. However, I think Kim has a point in the small caps. They have been more displaced by the larger companies for a while now. They've underperformed for quite a while now. Kind of like we saw on the international side of things for a couple decades. You get to a point where valuations, the disparity in valuations are so wide and they get so beaten down that it doesn't take a lot of good news to really send small caps or these beaten down stocks higher. You get a Fed rate cut once in September, another one in December. That could be the catalyst that would send small caps higher, at least compared to their large cap brethrens.
And if I can hop in here really quickly, that was one of the reasons why I really liked them, was because of that buyout. As the interest rate environment goes down, that smaller companies might get a look from the larger companies because it's cheaper to buy them.
So I think that viewers might be sitting here saying, oh my goodness, what do I do? Should I buy small cap stocks? Just to give you a little insight as to how we handle this issue of allocation, how much should an investor have in large cap, small cap, et cetera. When we're creating portfolios, we're going through a process called portfolio optimization, which means that if we're trying to achieve a desired rate of return with a desired level of risk, then what percentage do we need to have in each category, small cap, mid cap, large cap, growth value, that sort of thing, in order to achieve that outcome. So I think that the question on owning small cap really ultimately comes down to what is it that you're trying to achieve. When it comes to small cap, and the group has talked about this, right in line with our thoughts, which is management matters. If we're going to, the only reason why we would own a small cap index fund, which mirrors an index, would be for tax purposes. Otherwise, we are looking at managers. What is the manager's approach? Are they good at doing these things that we just discussed? And in fact, at Coghill Investment Strategies, just within the last few months, we actually made a wholesale change with the manager that we were using to manage part of our small cap position, because they weren't keeping up with what was going on in the environment. So we actually found another small cap manager that we liked and literally took all of our positions and flipped them in to a new manager. So, that's really the message here, is that management in the small cap arena really matters.
Okay, good. Well, a majority of Americans who invest in a 401k or an IRA until it's time to retire. If you have a client who also has a 401k, then you can offer advice on how they should be investing that money in their 401k. So what would be your advice on this move to open 401k plans to alternative assets or the private asset industry? Carrie, your thoughts?
Well, we're probably not all going to agree on this. I have a feeling. I'm not a fan of it. In fact, at our firm, we don't do a lot in the alternative space. And the reason for that is for the type of client that we work with, which are people that generally have been high income earners. They're used to having a lot of cash flow. So as they hit retirement, you might think that a $10 million portfolio is a lot, but when you're used to living off of $500,000 a year, you have to really proceed carefully. And the challenge that I have with managing alternative investments, private equity, those types of investments, is I can't model them. So I can't say, okay, if the Fed cuts interest rates, I have a good idea as to how this particular investment is going to perform. And in fact, there are a lot of different alternative asset classes that are designed to not correlate. So, I think for higher net worth clients, once you get to a point where there's excess assets there and you don't have to rely on those assets for cash flow and modeling, then I think that opens up the space to private equity and alternative investments. However, for those people really relying on their 401ks for retirement, it makes me a little nervous.
I'm in the alternative asset space. That's what I do these days. And that being said, I totally agree with everything Carrie just said. I think it's the worst idea I've ever heard of. I think you're taking people who have limited experience and exposing them to an asset class that is illiquid. And illiquidity is a dangerous thing. People like that will lose a lot of sleep, because these businesses that I invest in have good times and bad times. And I manage a multi-asset fund, and different assets have done well and poorly over the 5 years my fund has existed. And it's a real challenge maintaining equilibrium for me, who I actually believe I have a clue as to what I'm doing. And the point is, you can't sell most of this stuff. And because you can't sell it, you can't anticipate when the good time is going to end and get out. Because they end mysteriously. We had COVID since I started my fund. We had the inflation problem. We had interest rates go up. All these things are bad for private equity. And I'm going to put a little commentary in here as to why this is happening. The managers of private equity and these alternative asset class are used to distributing cash to their investors. And they distribute cash because they sell assets. And right now, selling assets is a problem. Interest rates have risen, and now the high rollers who invest in this stuff are pulling back their wallets from these people. So the brokerage industry and the Wall Street, let's blame the Wall Street, not the brokerage industry. Wall Street needs fees to survive. So they're going to open this stuff up to the fee guys. Now, from my perspective, as an owner of these assets, it's going to create liquidity, and it's going to give me an opportunity to finish my project in a logical way, I hope. And that's the operative thing. I hope. I don't know that. All right? And the reason is you don't know anything about the future. I mean, people sit and say for the foreseeable future. Has anyone been able to predict the foreseeable future? So I think it's a horrible idea to expose average people to these asset classes because they cannot afford to wait for the ebbs and flows of the total economy and not lose sleep because it matters to them. And whereas the high net worth person that can afford to be in these things can live through the valleys. Won't like it, but it won't hurt them. Did that answer your question, Stacey?
It answered my question.
Part of the reason why I think people are attracted to this, both the advisors and their clients, is because these are assets that don't price daily, right? You're not going to have the tariff tantrum kind of issue that happened. But here's the thing. Do you really believe that the asset's value isn't dropping along with the market? You should. You should know that because the business, the market represents what businesses are worth based on cash flow. There's no difference in the alternative market. That's what we're doing. Businesses based value is based on their cash flow. So you can see the assets go down daily if you look at your statement, but it will be a mystery to you as to what these alternative assets are worth. Now, their value daily will look the same, but practically they are not. So keep that in the back of your mind when you're evaluating whether or not you should own these.
I'll say this, Frank, for the foreseeable future, I did predict the future when I said not to sell in May and go away. So that's a point to us. Look, we use alternative assets in our portfolios. We've been doing that for 5-6 years now. A couple things to keep in mind. One is you have to right size it. I mean, you be very, very careful about not going over. Find the percentage for your client and make sure you don't go over that amount. I personally believe, again, every client's very, very different, Carrie. We know this, but I personally believe that liquidity is very overrated in portfolios. Most people don't need access to 80, 85, 90% of the portfolio at the drop of a hat, right? Now, a lot of the income you get from these over time, whether it's private credit, private infrastructure, which are heavily, private real estate, which is heavily interested or heavily comprised of income, you get paid out monthly, so you get a lot of that back anyway. But in regards to the 401k, who you invest with matters here probably more so than any other asset class. I mean, equities, the correlation between the top performing equity manager and the bottom performing equity manager, that gap's pretty small. The difference between the top performing private asset manager and the bottom one is very big. So I would be worried about in these 401k plans, even if they're not a big 401k plan, that you're getting somebody who's not very reputable, doesn't have a lot of experience, doesn't have a lot of assets in them. So I'd be very, very reluctant to be investing in these in my 401k plan unless you're very comfortable with the manager and the strategy that they're employing.
Well, I think the problem with the 401k, and you guys can tell me I'm wrong on this, is when you're talking about who you can invest with. It depends on what your company has decided, who runs your 401k, basically, doesn't it?
Yep.
It does, and there's a lot that goes into it. I mean, I think that, the idea of opening up 401ks to alternative investments, it's an idea, but the practicality of the implementation, when you're managing a 401k plan, if we were to be advising on a 401k plan, there's an awful lot of due diligence that we as the advisor needs to do and document, by the way, because we, the trustees of that 401k plan, have a fiduciary responsibility to bring good quality investments into the plan. So I think even if legislation was passed to say you could do it, I'm not sure that a lot of 401k trustees would actually adopt it.
Interesting. We only have about 5 minutes to go here, so I wanted to bring this one up before we go. It would appear the meme stock mania has resurfaced with a vengeance. One headline in the Wall Street Journal said the latest meme craze is flashing a warning to Wall Street. Hectic trading in Krispy Kreme and Open Door signals the return of reckless overconfidence. So, Michael, I'll ask you, can you give me an explanation of just what a meme stock is and your take on it?
I don't think you want to ask me. I don't know. I don't care about meme stocks. I don't follow any of these. But what a meme stock is, I mean, Kim could probably answer this better than I. But it's anything that gets a social media presence and then just gets on Reddit and then just takes off because of retail investors buying, despite no news on fundamentals, no news on valuations, no news on anything. It just catches a social media buzz and then it takes off. I think Open Door, which is like a $3 billion company, I mean, it's not a small company. $3 billion is pretty big, but I saw last Friday or last Thursday, it traded more than Microsoft did in the day, which is absolutely shocking in my opinion. But again, we had this a few years ago with GameStops.
Yep.
I never invested in it. At the time, I wish I did, but you just don't know when the shoe's going to drop. You can catch it going up, but you don't know when that knife's going to fall, or you just don't know when that knife's going to fall, and you're out a lot of money. So I never invested in it, and I don't anticipate I ever will, or my clients ever will, through me.
Again, I can't model meme stock, so we're not going to be buying it. I've always said that the stock market can be used for two things: investing and gambling, and this is an example of the gambling side.
Interesting.
And I agree. It's just, it makes for good press coverage because it gives people something new to think about in the Wall Street Journal and on, Yahoo Finance and all the other outlets. And here's the thing, it attracts people probably that have not money to burn, right? They think this is a sure thing. Their brother-in-law told them about it. Somebody told them about it. And it is not. It is a quick way to make your money evaporate.
Interesting. Frank, you want to wrap it up for us?
Yeah, lottery tickets take less time to lose your money.
Okay. All right. Well, so much for meme stocks. All right. Thanks so much. We'll continue our look at investing in the economy in future editions. And since you are watching or listening to this program, I ask that you hit the like or the subscribe button on whatever platform you happen to be using. So thanks again for joining us. We'll see you again in the next edition of The Bull, the Bear, and You.